We begin tonight with a rapidly developing energy story from North America that is already affecting fuel prices for millions of American households and could have long-term consequences for the U.S. economy. Over the past several days, Canada has implemented a major shift in its energy export strategy, redirecting significant volumes of crude oil away from the United States and toward European markets. This move is disrupting long-standing supply relationships, forcing U.S. refineries to adjust under pressure, and contributing to sharp increases in gasoline and diesel prices across several regions. Analysts say the changes unfolded with unusual speed. Earlier this month, Canadian authorities formally announced a plan to diversify energy exports. Within days, major pipeline operators confirmed that large quantities of crude oil, previously destined for American refineries, would instead be routed to export terminals on Canada's east and west coasts for shipment overseas. The volume involved represents nearly a quarter of Canada's typical crude exports to the United States. For refineries in the American Midwest and parts of the Northeast, this supply has been foundational for decades. Entire processing systems were designed specifically for Canadian heavy crude, making rapid substitution extremely difficult. This policy shift did not emerge in isolation. Trade tensions between the two countries have been building since late last year, following a series of tariffs imposed by Washington on Canadian industrial and agricultural products. Canadian officials signaled in advance that economic countermeasures were under consideration, including adjustments to energy trade. At the same time, European governments, seeking to secure reliable non-Russian energy sources, offered Canada long-term purchase agreements at premium pricing, along with financial support for port and pipeline infrastructure expansion. Those incentives significantly altered the economics of Canadian exports. For American consumers, the impact is already visible. In multiple Midwest states, fuel prices have climbed sharply in a matter of weeks. Data from fuel monitoring organizations show some of the fastest regional price increases since major hurricane disruptions in the mid-2000s. For households with long daily commutes, monthly fuel expenses have risen by hundreds of dollars, forcing families to adjust budgets originally set aside for savings, education, or healthcare. Energy experts stress that this situation extends far beyond gasoline. Canadian heavy crude plays a unique role in the U.S. energy system. Many refineries were engineered specifically to process this type of oil. Switching to alternative supplies often requires operational changes, efficiency losses, and higher costs. The disruption is now affecting diesel fuel used by trucking fleets, jet fuel for airlines, heating oil for homes, and petroleum-based inputs for manufacturing. Understanding the pricing dynamics is essential. North American oil markets rely on different benchmarks for different crude types. Historically, Canadian heavy crude traded at a discount due to its composition and refining requirements. However, as Canadian exports shift toward Europe, where pricing is tied to a different benchmark, producers are now receiving higher returns. This creates a strong incentive to prioritize overseas buyers. For American refineries, that means competing on the global market for supplies that were once regionally accessible at stable prices. Recent government data indicates that imports of Canadian crude into the United States dropped sharply within the first half of the month. Attempts to replace those volumes from other sources have been limited. Comparable heavy crude supplies are constrained globally, and existing producers either face sanctions, declining output, or long-term contractual commitments. The result has been immediate pressure on refined fuel markets. Futures prices for gasoline and diesel have risen significantly, signaling higher retail prices in the weeks ahead. Economists point to historical parallels. While the current supply disruption is smaller than the oil shocks of the 1970s in absolute terms, its regional concentration makes the impact more intense for specific parts of the United States. Refineries with limited flexibility feel the effects fastest, and those costs quickly move through the broader economy. The chain reaction is now becoming clearer. Trade measures led to export diversification. Export diversification constrained refinery supply. Refinery constraints pushed fuel prices higher. Higher fuel costs increased transportation and production expenses across nearly every industry. The final result is renewed inflationary pressure and slower economic growth. Projections suggest that if current conditions persist through the coming months, average national gasoline prices could rise substantially, with the Midwest facing the highest levels. Diesel prices are of particular concern as they directly affect trucking, agriculture, and construction. For workers and small businesses, the strain is immediate. Landscaping companies, delivery services, and independent contractors report fuel cost increases of 50% or more compared to earlier this year. Many operate on thin margins and now face difficult choices: raise prices, reduce services, or cut jobs. For middle-income families with multiple vehicles, fuel costs have become a significant new burden on monthly finances. Consumer confidence has already shown signs of deterioration, with surveys indicating a sharp decline as households respond to rising everyday expenses. Large industries are also adjusting. Trucking firms locked into fixed-rate contracts are absorbing losses while waiting for renegotiation windows. Restaurants face higher delivery surcharges that threaten already narrow profit margins. Airlines, where fuel is one of the largest operating expenses, have announced additional ticket surcharges to offset higher jet fuel costs, raising concerns about reduced travel demand during the peak season. Some sectors are benefiting. Domestic oil producers have seen higher revenues and rising share prices. However, analysts caution that increased production cannot offset the lost Canadian supply quickly. Expanding output requires time, investment, and regulatory approvals.
Internationally, the response has been mixed. European governments have welcomed the new energy arrangements as a boost to their energy security. Meanwhile, relations between Washington and Ottawa appear strained, with Canadian officials emphasizing their right to pursue economic interests and diversify trade partnerships. Other regional partners are watching closely, concerned about broader instability in North American trade relationships. The ripple effects continue into agriculture, manufacturing, and construction. Farmers face higher diesel costs just as planting season approaches, raising the risk of reduced acreage or lower margin crop choices. Manufacturers that rely on petroleum-based materials are seeing rising input costs. Construction firms report project delays as clients reassess budgets under escalating material and transportation expenses. Economists warn that these combined pressures could feed into higher consumer prices later in the year, particularly for food, housing, and household goods. Experts describe the situation as a breakdown in decades of North American energy integration that once delivered efficiency, stability, and cost savings. Rebuilding that framework or adapting to a new one will take time. Legal disputes may also emerge as refineries and suppliers review long-term contracts and pricing clauses. Any resolution through litigation could take years, offering little immediate relief. For now, the central concern is uncertainty. Families are adjusting daily routines. Businesses are reassessing operations. Policymakers face pressure to respond while balancing trade, energy security, and inflation risks. As analysts continue to evaluate the economic models, one conclusion is already clear. Changes in energy policy do not stay confined to energy markets. Their effects move quickly and broadly through the entire economy. This story is still developing, and its consequences will likely shape economic conditions in the coming months. We will continue to track the situation and bring you updates as more information becomes available.